Welcome to our latest episode of Julius Baer's Moving Markets, The View Beyond, a series of podcasts in which we delve a little deeper into the topics on investors' minds. My name is Ayako Lehmann and I am your host for this episode. Today we'll be having a closer look at the most important central bank of the world, the Federal Reserve. Following the news that President Trump nominated Kevin Warsh to be the 17th chair of the Federal Reserve after Jerome Powell's term ends in May, markets reacted instantly with a sell-off in precious metals and speculation that Warsh might bring about regime change at the Fed. What does Warsh's nomination really mean for financial markets? Before we get started, a gentle reminder for the audience to listen to this podcast to the very end to get the important legal information. I'm very pleased to welcome David Kohl, our chief economist, who has been following this new Fed chair story for months now. Welcome, David.
Good morning, Ayako.
So, this nomination of Kevin Warsh, did that come as a surprise to you?
Well, it was an open race before, so probably that was the intention, to get surprised. And yes, it was not entirely anticipated. The fear was actually that somebody would be nominated, which is much closer to Donald Trump, which is much closer to his thoughts, and which might even be turned out like more or less a puppet of Trump. So that was the speculation which was ahead of that. So yeah, it was a kind of surprise that it was probably not entirely going in this direction.
He's also considered to be a hawk, right? So is that a good or bad thing for the Fed?
Well, it's probably more kind of like to decide if somebody is dove or hawkish central banker. That belongs probably rather to this storytelling business of how do you rank them, how do you put them into context, and how the history is. So, and the history, he has this history that he had been against like too easy monetary policy, both on the like quantitative easing side, but also immediate rate cuts after the financial crisis because of fears of inflation. And this gives him like a standing, probably in this respect. And for the current decisions, probably is not such a bad thing, because we talk all the time about Fed independence. Is this an issue? Is there influence from the administration, from the Treasury, from Donald Trump, from the president on the Fed? And when somebody has at least a standing to be a hawkish central banker, then probably this fears that there is like influence coming from the administration, from the fiscal side, from the president, can be a bit booked down. Let's put it like that. And so overall, probably it might be not such a bad decision to put a more hawkish looking person on the Fed.
Okay, because yeah, as you say, markets were expecting somebody to be nominated that follows or executes what President Trump wants them to do, and now it looks like it's going to be a different story. So what kind of rate trajectory from the Fed are we expecting now? The beginning of the year at JB, we said probably 2 rate cuts are in the cards for 26. Does that change your picture now, knowing that Kevin Warsh will most likely be the new Fed chair? I mean, we all have to also say at this stage, the Senate still has to approve that, right?
That's true. That's two things, of course. When it comes then to the actual rate decision, there had been probably in this process who will be the nominee and who will be then finally approved and also by the Senate, who will become Fed chair. There's a bit of overrating what a Fed chair can do and what he cannot do. Decisions in the FOMC within the Fed are done basically that everybody has one vote, including Kevin Warsh. So it's not that he comes there and he decides everything on his own. There are 12 people, 12 voting members, which decides on the interest rate decision. It has to be a majority. So it's basically not changing much, like compared to how the storytelling is, where the Fed is going. And this leads me to your question, basically, what do we expect from the Fed? In there, we had been before, like very much aligned our view where the fundamentals are going. And there are two numbers, there are two economic data which has to be closely followed. One is the dynamic of the labor market and the other is inflation. And we think both of them will eventually allow the Fed to cut rates a bit further. And I emphasize a bit further. So we think 2 rate cuts by each 25 basis points or 50 basis points in total might be okay. Once the labor market shows further signs of slowing, and we've seen that, and once also inflation becomes a bit more good behaved, so comes closer to this 2% target the Fed has.
Okay, so you're very much expecting the Fed to remain data dependent as they've been basically also over the last few months, years.
Yes, exactly. So, and the reason for that is that why Kevin Warsh is not changing anything on that, on the data dependency is, first of all, only one vote in the FOMC, in the decision-making body of the Fed. And the other one is that probably his arguments and his standing and his view on the economy are not so different to be actually data dependent. So when he wants to articulate this vision of lower interest rates, he makes this dependent on lower inflation. He has a very nice storytelling there, or nice story there, saying basically that this AI revolution, which is coming, is bringing down or is increasing productivity, and this helps to increase economic growth with low inflation. And that's the major reason. That's the major story he tries to sell. He tries to justify lower rates going forward.
Okay, so when we're expecting low rates, that means most likely that automatically means the US dollar will weaken further. It's been weakening the whole of last year and it continues to weaken with some pauses in between. What does that mean? What does it do to the US dollar? Again, that the whole topic of US dollar debasement is maybe back on the page. And also, does this depreciation make sense or not?
See, I think we have to distinguish here a bit. I think lower rates per se will probably not drive the debasement debate for further. It might weaken the US dollar a bit further, but in a controlled manner. And that's basically the decision here, to have a chair coming to the Fed, which is not cutting rates because of political influence or because it doesn't fit with fundamentals, helps a bit to stabilize this US dollar depreciation and take a bit out like the debasement story out of that. So what is debasement and what's the difference to depreciation? Well, debasement is that political actors, including the central banks, but also the Treasury and the president, actually want and work on a weaker currency. With this nomination, which seems to be quite reasonable in terms of that the Fed will most likely continue to act in line with fundamentals and not in line with political will, probably this debasement story can take a backseat. We have to much more look at fundamentals, what they mean for the US dollar. And yes, you don't have to go so far to look at political influence. We think lots of fundamentals are aligned, that the US dollar will continue to weaken, at the same time in a controlled manner. So we are much more confident that this depreciation of the US dollar will be rather controlled and not like we have seen last year, for example, during this political upheaval when tariffs had been introduced, or things like that. So it will be much more controlled.
Okay. The overall picture, I think if I remember correctly, your team is saying the dollar is still slightly overvalued. So there is actually good reasons for depreciating further.
That's correct. That's one that the starting point is, of course, one that the US dollar is quite expensive. It's highly valued against a number of currencies. The other is that the US still have a huge current account deficit. That's like a number which tells you how much dollar is actually flowing out of the US. And you have to bring them back, attract these US dollars to come back. And you can do that via higher interest rates. When you don't do it via interest rates, then usually you can do it also with a depreciated currency. It's more attractive for foreigners to buy US assets when they are cheaper for you. We know all that, and the currency can play here a role to basically balance this current account deficit the US has. And of course, it contributes also to the mere fact that the US probably does not want to have the same current account deficit, so much more imports than their export in the future. And they also, a dollar depreciation helps to balance that. So there are a number of reasons why a weaker US dollar is good for the US. and it's not only the question who is basically Fed chair here.
Also, the Fed's balance sheet is something investors have in focus. Does the Kevin Warsh nomination change anything regarding Fed's balance sheet?
That's a good question, and that's probably a bit like in the background, because it's very technical what the Fed balance sheet means actually, and how it influences investors at the end. And there is probably the truly risky part when we listen to Kevin Warsh, the nominee for the Fed chair, because his intention is to shrink this balance sheet. And that would mean a bit different kind of monetary policy, not so much in steering economic growth back and forth, but to avoid like risk-off events in financial markets. So it's much more important for the volatility, the risk sentiment on financial markets, if the Fed decides really to move away from a big balance sheet. Big balance sheet of the Fed means that the Fed runs basically an ample liquidity regime. That means it supplies the market with ample liquidity. Liquidity should never be the problem. Kevin Warsh said that this is a problem because this incentivizes risk behavior where you don't want to see that. There's this famous Fed put. So every time something goes wrong, the Fed jumps in. He wants to scale back this active role the Fed has in financial markets. And there, of course, that means that without this ample liquidity, with like a smaller balance sheet, that would mean for financial markets that you have more severe risk-off events, more volatility probably as well. So there is really the question how the Fed will manage that. And there are probably indeed then more the risks than just looking at the independence and setting interest rates. So this is something we probably need to watch, and let's see as well here how much Kevin Warsh can put through, because also here it's not his decision, it's a decision done by 12 Fed governors and local Fed governors.
Interesting. So you're basically saying on the Kevin Warsh there will be no quantitative easings anymore?
In terms of quantitative easing, in terms of understanding that as an active policy to support the economy, we don't see that. And it wasn't there also with Jerome Powell and other Fed chairs. It's more that he goes even further. It's not about quantitative easing or quantitative tightening. He wants to basically scale back the Fed's role in terms of avoiding risk-off events in financial markets. Financial markets in the US and in the US dollar terms are basically cushioned with ample liquidity, and the regime is called ample liquidity regime. So liquidity should never be the problem. And he wants to scale that back because his idea is that this incentivizes wrong behavior at the end. So will there be quantitative easing, quantitative tightening? I think this depends really on the level of interest rates and the level of crisis. But the direction he at least proposes, again, is that this issuance of ample liquidity, that this will be scaled back. We think this is a risky and difficult task, and it remains to be seen if he can really convince his colleagues at the FOMC to follow his ideas there.
We've talked now lots about the Fed, Kevin Warsh. Let's look at the potential impact on financial markets. Look at treasuries, fixed income in general, equity markets. Maybe start with US treasuries. US treasuries have also been very much in focus these days. People got concerned. Lots of investors started to move away from US treasuries, saying this is no longer sustainable. What's going on in the US? Do you expect any changes there with the new Fed nomination?
Well, here, we're coming back to this topic, is the Fed independent, or at least independent enough for the treasury market? Well, we have not seen any reaction actually on the treasury market following the nomination. And for us, this is like a preliminary judgment that probably the treasury market, this segment thinks, well, this Fed chair is probably not the worst outcome. It's not the one which is a Trump puppet. It's not the one which will cut rates, although it does not make sense, although we have like inflation is running out of control. And so the judgment so far for treasuries had been, this is okay to live with them. He's not have spurred a rally in treasuries, so bringing rates down. But it's basically something where most of the market think this is actually not so bad. This will not be something where policy is being driven by political will, but rather by fundamentals. And for the treasury market, that means stability. And with these yield levels, it's actually a good asset class. You can earn this more than 4% with a yield, and you have a cushion because of this nice yield.
Okay. Interesting. What about the fixed income investors in general? I mean, when we just spoke about it at the beginning, rates expected to come down further. What does it mean for fixed income investors? What should they do with the duration, for example?
Well, we would look at the belly of the curve. So we think there you can at least profit a little bit from lower short-term rates. So, of course, the Fed can only influence the short-term rates. For the longer-term durations, you would really need to bet on bad economic outcomes, and this doesn't look like that. So it doesn't look like the economy would move into a recession or any other crisis type. Then you would look for really long duration. But so far, we think that when you want to position towards monetary policy, which sees some easing, you should probably go rather to the medium-term durations going forward.
Okay. What about US equities? I mean, in our Market Outlook 26, we said, yes, you can still focus on US equities, but maybe this is now a good moment to actually diversify away from just being focused purely on US equities. Does that stance still hold?
Yes, it does. And then, of course, there are two things for when it comes to US equities or equities in general. Then, of course, they might get some support from lower interest rates in particular, but also on the longer term. So the whole curve should come down. That would help equities in terms of like bringing down term premium and so on, and increasing the net present value when you calculate the future earnings. When it comes to US equities and the question, should you diversify out of this universe, that it's more the question, what does this Fed policy and the nominee now as for the Fed chair do for the US dollar? We think it does not change the direction of the US dollar. Gravity is basically pointing to depreciation of the US dollar. It avoids probably this sharp depreciation moves, which could have been expected with a more dovish Fed chair. But it maintains actually our recommendation to diversify away from the US in terms of asset allocation. And the main reason is here that it doesn't change the trajectory or our forecast when it comes to the US dollar, that there will be some depreciation going forward.
Okay, final question. I mentioned in the introduction, precious metals haven't been on a roller coaster in February because of the whole nomination process and the financial markets not quite knowing what will be the outcome. Do you think this gold, silver, roller coaster ride will now come to an end, that we now know the way forward?
Well, that was part of the story. At least this is what we get when we talk with our colleagues who have a really deep look in the precious metal markets. They say the prices have very little to do with fundamentals. And from my side, I would be also surprised when really a nomination of a Fed chair changes really the fundamental backdrop for how much is a ton of silver being valued. Mm-hmm. So it's very much driven by speculative behavior. Yeah. You have seen the big swings there. And probably people tend to forget the silver market and gold markets. They are quite small markets. We talked about US equities, US treasuries. These are the really big and liquid markets. Yeah. And of course, when volumes are smaller, then speculative behavior can cause much higher volatility. And that's what we have seen. I think the Fed nomination and who becomes the new Fed chair was just a sideshow for this heightened volatility there. We had seen big moves. It's a future market. It's a small market. So it was probably a part of explaining the moves and not causing the moves, which we have seen in gold and silver.
Absolutely. Especially silver is even a smaller market than gold.
I agree. Yeah.
Wonderful. Well, thank you so much, David, for joining today and for your time today.
Thank you, Ayako. It was a pleasure.
And with that, we've unfortunately reached the end of this podcast episode. Thank you to my guest, David, and thank you for listening in. We hope you enjoyed this episode, and we'll be back soon with new ones. Bye for now.
The information and opinions expressed in this podcast constitute marketing material and are not the result of independent financial or investment research. Please refer to www.juliusbaer.com/legal/podcasts for further other important legal information.